Hey there, everyone. My name is Ryan Schul. Thank you for tuning into my YouTube channel today. Today I want to talk about Bayesian network analysis, and we're going to measure systematic risk. So, what's systematic risk to begin with, right? So, it's a risk inherent to the entire market or the broad sector of the economy that cannot be eliminated through diversification, right? So, if you want to invest in hardware or software or consumer goods or durables or something like that. Like you can diversify your risks among different type of investment vehicles, right? Or whatever it is. But the market risk is everything, everywhere, all at once, right? You can't eliminate this. All you can do is take all your investments and go into cash, right? And give everything to the bank, and the bank will gladly take your money, right? And they'll pay you like whatever it is right now, 1/5 or 1/4 of 1% for interest. That's basically nothing, right? But it's very safe, and the bank really can't go out of business unless you're Silicon Valley Bank. Then you can go out of business, but you still have your investment guaranteed up to I think 250K or something like that. So it's pretty safe. But honestly, like you have to be in the market, right? You have to be invested. Like yeah, I can take all my money and put it into Chase. We have a Chase bank close to where we live. I can take all the money and put it in that, and they're going to diversify that and allocate that and delegate that into different investments like mortgages and student loans and car vehicle loans or whatever you want to do. They'll take care of that. I'll go work for them and I can go do that very easily, right? I can optimize and make that very efficient. But is it really the best way to use your time and to use your brain power? Probably not, right? Like so systematic risk is something that we have to measure and understand and try to delegate efficiently. And there's ways that can be made more efficient. I'll come up with a couple of videos. I don't work for any institution right now. I just work for YouTube. That's it. Like I can go work for Chase. I can go work for JP Morgan. JP Morgan actually is my great, 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 great grandfather, if I said correctly, 4 times great. And that's fine. I can go work for him. I never got a penny from that. And now JP Morgan's like the head is what Jamie Dimon or something. Like I saw a couple of his videos. Like doesn't strike me as very intelligent. Just a guy that just talks about a bunch of stuff, and he has top lieutenants that report to him, and whatever he's get into that thing, right? But not super intelligent. Just like getting through the day. Let me do this. Let me do that kind of thing. Things like that, right? So, anyways, let's put that all on the side. Okay, I don't care about JP Morgan. I don't care about Chase. I don't care about banks. I don't care about that, right? So you have to diversify, right? You have to take your investments and diversify those to reduce concentration risk, right? And protect yourself against systematic risk or engage with systematic risk because it affects all investments simultaneously, right? So I put together a small script today. So I have the regular libraries that I'm importing. We have the Fed, US dollar, VIX. If you don't understand VIX, let me take you through that really quick here. Finance, Yahoo. I love finance. Yahoo basically does everything I need it to do. So the VIX is a volatility index. So let's take a look at this thing right now. Just quick engagement. Okay, so down 2.14%, and that's fine. That's fine. All this does is measure the volatility over time. So if the stock market is more volatile, VIX goes up. If it's less volatile and just horizontal and just not a lot of movement or whatever, then VIX is down, right? It just measures the volatility over time. If you go over here, 6 months down 21%, that's pretty obvious, pretty expected, pretty much expected. If you go back 5 years, 5 year time, there's a big jump over here. This was 2025. Yeah, I remember that was like the flash crash, right? People didn't really expect that. If you go over time, so 2000, this was the dot-com bust right here. So VIX spiked up after that. Oh wait, 2001, sorry. So VIX spiked up after that. This was the financial crisis, right? Everybody loves that. I embrace it. I love the financial crisis. This makes no sense whatsoever. Whoever came up with these ideas, it's like absolutely insane. This is COVID, pretty much guaranteed COVID. Yep, COVID was the next month, March 2020, right? So it just measures the volatility of the index, right? And you have credit and equity, high yield, and things like that, right? So let me hit Control Enter to run this, okay? And we have the VIX, right? That's what I just showed you right now. Credit, U.S. Treasuries, 10-year right there. Equity, U.S. dollar, and banking. Okay, so this is basically a dictionary, right? It's called DICT. D-I-C-T is kind of like the data type, right? You have like a couple of or just a few different data types. You have a dictionary, list, data frame, and what's the other one? Dictionary, list, data frame, and what's the other? A series, right? Or you only have a couple different data types, a few different data types, not couples too. You have a few different data types in Python, right? So this is a dictionary, right? So let me take you through this. Now, if we go over here, we have a small UDF that I created. This is called a user-defined function, and you input a parameter or a couple of different parameters. Here we just have one. This is the data frame that we just created, and then you have different scenarios. You have a baseline with Fed plus 100 basis point increase. Right, a basis point is like a tick of interest that the Fed controls. Right, I think they just put out like a 25 basis point decrease in interest rate to try to stimulate the economy. If you decrease interest rates, it makes it cheaper to borrow money, and it's easier for people to get loans for whatever you need to do, right? Like run a small business, or get a student loan, or buy a car or something like it, or even a mortgage, right? Like a mortgage, it's a little bit cheaper to get these loans to do what you need to do, right? So we have recession scares or oil shock. So a shock to the system is something that you don't necessarily expect, but it can change the directory or the trajectory of the economy quite a bit, right? If there's an oil increase, if oil increases 50%, that's a big shock in the economy. Like maybe people don't necessarily expect that. Maybe people don't understand what's going on, right? So some kind of shock to the system or scare or surprise or something like that is going to have an impact, right? It's going to have an impact on your investments. So we have to understand this. So the Fed can have a 100 basis point surprise up or down. It can go either way, right? You don't know what's going on. Recession scare, liquidity, Fed inflation, or oil shock, right? So let's go ahead here, hit Control Enter, and we can see what the features are over here. So this is baseline, Fed surprise, recession scare, and oil shock. So this is the VIX. That's what I just showed you a few minutes ago. This is the point up or down, right? So credit spread and basis points, 10-year yield, equity returns, high yield return, investment growth, and U.S. dollars abroad, and bank stress problems on the system, right? So when we go ahead and we input all of this, Control Enter to run the cell, we can see what has the biggest impact on a federal basis point change to price. So the Federal Reserve should pay attention to this, right? Equity returns of negative 3.56 that can or federal basis point change can have a negative impact on equity returns, right? So if you increase rates 100 basis points, yeah, that's going to have an impact on the stock market. Like equities are going to go down about 3.56%. High yield returns can go down 1.94%, close to 2%. Investment growth goes down a little bit. Bank stress problems doesn't really change, 0.13, not too much. VIX, 0.45. So VIX, again, is volatility index, right? So a big surprise from the Federal Reserve, 100 basis points. And that's pretty big, guys. Like usually it's 0.25, 0.5, 50 basis points, whatever. So that could be a change, but people kind of expect that, if the economy is lagging, okay, we're going to get a bigger stimulus here from the Federal Reserve. They decrease rates 0.25, 0.5. If they increase one 100 basis points, that's a big shock to the system, okay? The US broad dollars, US dollars is going to go up about 72%, right? 0.72%. 0.72%. The yield on 10-year treasuries is going to go up 6.44%, right? So that's pretty big. And the credit spread on basis point is going to go up 0.72 or 2.7%, right? So that's a big change, guys. It's a big change on credit spreads, right? So that is going to have the biggest change if the Fed goes down increases 100 basis points. That's could be 72. I'm sorry. What is this? 2.7%, right? You can see that right there. Okay. So the baseline draws all exogenous drivers, growth, inflation, liquidity, all these things go into it, right? The scenario is and what was the intervention? What's the intervention here? What's the inflation? Things like that, right? And bars show how key outcomes move relative to the baseline, and the DAG colors, this is data analytic graph colors, show where the shock hits hardest and in which direction. So now we're going to go ahead and hit Control Enter to run this, build network graph, okay? And I'll give you guys all the code for this. I'm going to give you everything that you need to go ahead and run this scenario by yourselves, right? You can copy and paste this into your own Jupyter notebook and run this for yourself, right? I'm going to give this all to you when I post this video a little bit later today. So we're going to go ahead and plot network graph and show all the intervention and the interaction here all at once, right? So I'm going to show you everything all at once, and this is going to show you the Bayesian network and let you see how this scenario propagates through time and how it changes over time. And you can see the circles, these are the nodes and the variables in this model, and the green and red show how much variability there is based on the underlying or the baseline under this scenario, right? And arrows show edges, and red arrows show positive effect, blue arrows show negative effect, and the thicker the arrow, the stronger the effect, okay? And you can hover in any node and you can see the effect between these different entities, right? So here's US Treasuries, 1.26 positive. This is investment growth. This is inflation. This is growth over here. This is banking and high yield. And what else? Let me zoom in here. Let me zoom in on this. I love these graphs because you can zoom in, you can see all the details when you get in there. So this is VIX, this is what I showed you before, this is volatility, this is credit, and this is growth. Double click and you can get out of it, okay? And this is equities, right? So green is good, red is bad, right? Positive and negative, and this is kind of like a bullish and bearish kind of scenario. If systematic risk increases, this is the effect right here. So green is variable and moves up, and red is a move down, right? So the variability in the node size bigger is a bigger move, and smaller is just smaller, right? The edges show positive influence, and the sources tend to push up the target variables, and the blue is the connection between these different nodes, right? So green is good, red is bad. There's risk indicators, and VIX shows credit spreads and commitment to wider growth as systematic risk increases or decreases over time based on Fed movements, right? So the Fed is the Federal Reserve. We're looking at oil and US golds. We have a lot of commodities in here, and we're understanding like the whole exogenous mix on the economy, right? That's what this analysis is for. So I also like to use PyVis. So this shows a very dynamic interactive graph. When I run this, you can see all the code here, and I'm going to share this all with you guys, right? I'll literally download this right now, okay? So I'll download this. Export as HTML. Okay, I'm going to share all this code with you. So basically, the colors and the edge rules described as above shows all the numbers, all the DAGs, right? A DAG is a data analytic graph, and it shows everything in the connection between all these different entities, right? So We look at the Fed, we look at the US dollar, we look at the VIX, we look at gold, we look at US treasuries and things like that, right? So these are the connections between all these. So you can zoom in, you can see the connections and the strength of the connection. So again, green is good, green is positive, red is bad. The bigger diameter of the circle, the more intense the strength. So here is negative 1.97. Here is negative 0.804. Slightly smaller number and slightly smaller diameter of the circle. This is positive 2.043, and I can actually move this and get this out of the way. 2.006. If you put this right close to that, it's a little bit smaller, and this one's just a little bit bigger. Sorry, so you can see the connections over here. This is negative 2. I can move this out of the way. I can move this, and this is negative, and this is negative, and this one is positive over here. I can put this one over here. Positive 1.255. This is negative. I can see that right off the bat here, negative 1.5. And if I take this is actually positive over here, and this is going to give me 0.489. But you can see it's smaller than these over here, right? So smaller number, smaller diameter of the circle, and bigger diameter of the circle, like bigger number right here. And if I put this over here, this is going to be negative 1.17. If I zoom out a little bit and just pull this thing over here, maybe pull this over here, just get everything situated in kind of nice formatted, nice fashion over here, and pull everything in. And then you can zoom in. You can see, again, green is good, positive, and red is bad, and it's negative. And if you go down here, you have different controls. You can play around with. You can play these things, and it gives some bounciness or some wibbliness. What is this? White overlap. Gravity. And it's one that really changes it. I forget which one, but it makes it very dynamic and very interactive over here. Oh, maybe that's the one. Okay. So you can see how everything based on this network graph is integrated and moves together, and it's pretty real-time, pretty much simulated how all of these different items or different features interact with each other, right? So if the Federal Reserve increases interest rates, right, this is the impact that's going to have on the economy, and all these different spillover effects, right? And VIX and banking and credit and U.S. Treasuries and oil and equities and the growth of the economy, the liquidity of the economy, right? So this is a pretty big stimulus, interactive, exogenous event that spills over into all these different features. So that's it, guys. So I already saved down the file. I will share all that with you when I post the video a little bit later today. Thank you for your time. Thanks for tuning in. I like doing these different educational types of videos to inspire and motivate people, and to share my intelligence with other people. I got my MBA in finance about 2003, 2005, 22 years ago from Johns Hopkins. So I learned a ton. Worked on Wall Street for like 22 years. I learned a ton. Just sharing my knowledge, my insights, my education, my evaluation, my experience with you guys. That's all this is for. Okay, that's it. So that's it. Hopefully this was intellectual and educational and inspirational and motivational too, maybe, hopefully a little bit. That's it. I'm going to wrap it up here. Thank you so much for your time. I'll post another video soon, and I'll see you guys in the next one. Take care for now. Bye.